Hi everyone, it's Robert. So today we're going to talk about something pretty basic in the loan industry, which is mortgage loan products. So I've met a lot of loan officers in my life who essentially recommend one or two products to their clients, and that's it. And it's really just because that's what they're familiar with. You see, 90% of all mortgages are 30-year fixed mortgages, and two-thirds of all mortgages are conforming mortgages. But there are a lot more options out there for you. So I wanted to make this video to essentially let you know what your options are. So again, we're going to take a light overview of each of these five categories of mortgage loan products. We're going to go over conforming, FHA or the Federal Housing Administration, VA or veteran. We're going to go over the affordable housing loan programs, and we are also going to go over non-conforming slash portfolio loan programs. So let's begin with the first one, conforming. The first big one is conforming loans. These are loans that meet certain parameters that allow them to be sold to Freddie Mac and Fannie Mae. This is by far the largest category of loans. When someone tells you about 20% down, this is often the product they are talking about. If you choose to do that, you won't have PMI or private mortgage insurance. However, it can still go away once you meet certain equity requirements. You also might find less property restrictions and occupancy restrictions. For example, investment properties are allowed. Or, if you're buying a condo, your property doesn't have to be on an approved condo list. However, you may find it more difficult to get approved credit-wise for this program. For example, the minimum credit score is 620, whereas FHA, the next loan we are about to discuss, can go all the way down to 500. While Freddie Mac and Fannie Mae are government-sponsored entities, or GSEs, FHA loans come from the Federal Housing Administration and are backed by them. The FHA is part of the U.S. Department of Housing and Urban Development, or HUD, and FHA insures mortgages for these homes. While previously mentioned, some of the credit requirements are easier, there are some drawbacks in comparison to conforming loans. Most notably, mortgage insurance is required and doesn't go away at 20% equity. You'll also find in addition to a monthly fee, there is upfront premium you have to pay as well, but this can at least be financed. One nice benefit, however, is that all FHA loans are assumable. This means you can transfer your loan and terms to another buyer as long as they qualify. If your rate is really low compared to the market, this is very attractive. Another type of government loan comes from the Department of Veteran Affairs. These are called VA loans. VA loans are designed to make housing affordable and easy for those who served our country and their families. Eligible individuals can get zero down payment with no monthly mortgage insurance. There is no minimum credit score with VA loans, though that doesn't mean your score doesn't matter entirely in conjunction with other factors. There isn't much downside to this program other than the VA funding fee, which is an upfront fee that can be expensive but fortunately financed. Even this, however, can sometimes be waived under certain circumstances, such as if you were disabled in service. To see if you are a qualifying individual, visit va.gov. There are minimum service requirements to know about. It's one of the best programs out there if you are an eligible individual. For those that aren't veterans, you can still get an affordable housing program to get close to or obtain that zero down payment. There are hundreds of these. Each state, city, and county have their own unique programs available. Oftentimes, the requirements of these go above and beyond the basics. Because there are so many, we'll cover just two of the federal programs to keep things simple. The Rural Development Branch of the U.S. Department of Agriculture, or USDA, offers its program to develop rural areas. The USDA program is for those who need it rather than want it, which is why there are additional income restrictions and asset restrictions on the program. You need to be under the income requirements, yet still have enough to repay the loan. It's also not for those who can afford a typical 20% down loan. To find out more about what the current guidelines or restrictions are, you can visit rd.usda.gov. HUD revitalization programs offer additional affordable housing opportunities. The programs target geographic areas authorized by Congress under the National Housing Act. These areas are determined by household income, homeownership rate, and FHA foreclosure activity. HUD-owned properties in these areas are eligible for discounted sale through special programs. Many of these are sold back to the asset-controlled area participants, which is mostly local government and non-for-profits, so they can help their communities at a more local level. Though with the Good Neighbor Next Door program, teachers, firefighters, law enforcement, and EMTs are eligible for FHA loans on these properties with down payment as low as $100 instead of 3.5%. The final category, non-conforming loans or portfolio loans, is fairly large. Anything outside the typical loan terms or underwriting standards set forth by the government-sponsored agencies is considered a non-conforming loan, and there are many types of them. Government loans are considered non-conforming loans, but often when this phrase is used, it's not used to describe government loans, but more of the outside of the box type of loans. Jumbo loans are a common type of loan that fall into this category. These are mortgages over the conforming loan limit. Other examples can include, but are not limited to, interest-only products, ground-up construction loans, or loans designed to overcome a borrower eligibility issue that exists on other loan products. And since these loans are not bought by the typical investor and normally carry higher risk, the interest rate will also be higher than normal. These are your outside of the box options. And if you want one of these, know that products vary greatly from lender to lender. So now that we have discussed these mortgage loan options at a high level, hopefully you have a better idea of which one is a good fit for you, so you can do a little bit more research on your own. Or you can always ask me questions in the comment section below. I'm happy to answer any questions. In the meantime, have a great day.